All right, so John Hyre, what can I say about John Hyre? He is very colorful. He's not always politically correct, very conservative, gun-toting, kung fu fighting, ridiculously smart. You've got to really listen to him to catch everything that he says because he's incredibly intelligent, and I mean that sincerely. He's got an amazing wife back in Puerto Rico who will kick his butt if he gets out of line, and we love her too. And she's an amazing artist as well. So he's got like both sides. Like John is the smart lawyer, incredible fighter of the IRS and taxes. And then his wife is sweet and makes beautiful artwork. It's like a beautiful combination. I love John's passion for helping investors on taxes. I can tell you personally, I felt like I paid way too much tax this year. I just did a quarterly. Anyone else? I hate it. And anyways, I get a lot of depreciation. I have a lot of assets, but it's some years it isn't enough. This is a session where you're going to learn to save a lot of money and really be a lot more savvy on your taxes, and it's something every person in this room needs, because none of us need to pay more taxes than we need to, because our government blows it anyways. Am I right? So on your feet, and a big round of applause for the amazing John Hyre.
All right, so this year I got notes. Real briefly, for those of you, how many of you have not heard me speak? Have not? Okay, got some virgin disclaimers to give. I don't do woke or PC. I would say I don't care about your feelings, but it's a lie. I actively enjoy trampling upon them. It makes you better, a la Friedrich Nietzsche. I'm a tax attorney. I live in Puerto Rico because I pay no federal income tax. My tax rate varies between 4% to 6% per year. My wife's there because there's a great art school there, opposites attract. The tax savings more than pay for my living, and it's a decent place to live. It's got its issues. I mean, it's even by Latin American standards, it's got its issues. She told me she wanted to move somewhere that she did not see snow and did hear Spanish. We got 1 out of 2. There's no snow in Puerto Rico. For those of you who speak Spanish and have listened to Puerto Ricans, it's arguably Spanish. It's like they talk like machine guns on cocaine with every 5th round missing from the belt. But a lot of fun. Question for you guys. So I'm a lawyer. What do? I don't deal well with employees or, frankly, humans. So I don't have a staff. One assistant, that's about it. That's all I can handle, barely. So I do provide services, but not a lot. I bill about 2 to 3 hours a day now, $1,000 an hour. Most of it's tax planning, some of it's tax fighting. I do a lot with real estate investors, self-directed retirement accounts, and general business tax planning. Now, I do put out a lot of content. I can just reach people that way more. I don't have to have employees. I don't have to be nice to anybody, and it pays better than $1,000 an hour, so there we are. I am very good at what I do, and I know it. Now, I'm not very good at anything else, but in terms of tax stuff, I'm very good at that. I do my homework, probably to a fanatical degree. We're going to have a little time for Q&A, but here's what I want to know from you. So you got a guy who normally charges $1,000 an hour. Normally you can't get a hold of me because do the math, 2 to 3 hours a day, you end up waiting a while. So am I a good fit for, hey, I'm your tax guy? Oh, hell no. What am I really good at? Planning. Give me your stuff, make it not urgent. If it has to wait a month or 2, that's fine. I look at all the stuff. I save you a bunch of money. That's what I spend a lot of time on. That and fighting the IRS. I love fighting them. I love suing them in tax court in particular. It's fun and easy. And we'll talk about that just a little bit. How many of you are newer to real estate? Get them up there. I need information. You are not my wife. I cannot read your mind. How many of you are advanced? Hands up. Get them up there. How many are somewhere in between? Okay, shout out. What are a few of the issues you want to hear about? Just shout it out. Louder. 401k and separation. A little specific. I might cover that separately one-on-one if you can catch me. Bottom line is this: in 35 states, if you have a spouse that has a 401k at the W-2 job, you can get a court order called a quadro, QDRO, Qualified Domestic Relations Order, that you're having a marital reorganization. I don't do that with my wife because her answer would just be, you see that? Yes, Edie's mine. Organization done. So for the rest of you, however, if you want to get money out of somebody's work 401k into a self-directed account, by the way, we were just talking to somebody up here. For self-directed, I vastly, vastly prefer 401ks, whether it's a solo 401k, a single member ERISA 401k, or multi-employee 401ks. And yes, you can have employees and still self-direct. There are different types of 401ks. You have to be a little careful. For example, in California, IRAs get almost no asset protection. Asset protection for IRAs and solo 401ks is state by state. California, to name one bad example, because anytime you want a bad example, California will serve. California's asset protection on IRAs and probably solos, I didn't look up solos, but it's probably the same, it's enough to support you, which means nothing. Their view of support is about 60 to 70 grand a year after subtracting any other income you get from Social Security, other pension plans, etc. So in California, you might want a federally protected 401k. If you have a small business, even if it's just you, you might want to pay extra to set up what's called an ERISA single member 401k, ERISA. There are people who will do that. That's a federal law. It preempts state law and provides much greater asset protection. So, and that, by the way, all of you need to look up in your state, talk to someone who knows. Here's the problem. There's no reliable online list of state law protection for IRAs, 401k solos, etc. There is a list. A couple of custodians have put them out. They're all obsolete. I've looked at a few of them. And then I looked at the law. For example, they say Indiana and Montana protect solo Ks. I read the law. I couldn't understand it, which, bear in mind, I read the Internal Revenue Code for a living. When your law is so badly written I can't understand it, you got issues. Indiana and Montana, I could not figure out if solo Ks were protected. No one's willing to pay me to figure it out. They would just be like, John, in your copious spare time, figure it out and let us know. I'll get right on that. But you want to think about, when it comes to the asset protection, the custodians, and especially the vermin out of Utah and Nevada, will tell you a lot of things that are not right, like your account is protected. That's much too general a statement. Watch out for that. So I prefer 401ks over IRAs. You can have both. Ideally, you can roll the IRA money into a 401k. When do you start with these plans? It's the most tax efficient thing you can do. Peter Thiel. We know this because the objective and caring left-wing commie employees at the IRS leaked his information. He turned a $2,000 Roth IRA into $5 billion. He doesn't worry about tax deductions in his Roth because the income is tax-free. That's a good starting point. When do you set one of these up? As soon as you're making enough money to live. Everything else should go, if possible, through one of those accounts, because then you just don't pay tax. What's your primary objection? Well, then I can't spend the money until I'm 59. What's my counter? You weren't going to anyway. You're cheap, damned real estate investors. What do you do with your excess money that comes out of your investments? You reinvest it in more investments. Oh, but I want to know I could spend it. Well, great. You could take a premature distribution. Now, premature before any other word is usually bad. I'm just saying. You could take a premature distribution out of your retirement account. It's just there's a tax and penalty to pay. But for those of you who aren't running things through retirement accounts, you're really hurting yourselves. It is the most tax-effective device in existence. Nothing touches it, especially given how you all invest. If you make more than 12% on your investments annually on average, and you're not running it through some sort of Roth account, and there are several types of Roth accounts, you're doing it wrong. So you really need to think that through. Watch out for generalizations. Why would I put one tax shelter inside of another? Don't put rentals in your retirement accounts. I've seen situations where that makes a lot of sense. Let me give you an example. You're really good at rentals. You're really good at rentals. And that's all you're really good at. Oh, well, they said don't ever put a tax shelter inside of a tax shelter. I'm not going to put a rental, which creates depreciation, inside my IRA because somebody gave me a stupid generalization. So I'm going to invest it in crap I don't know about. Seems like a bad idea. What's the number one rule of what to invest in an IRA? Whatever you're good at, assuming it's something that can be done in an IRA. Like if you're good at running a bordello, I'm assuming you're in Nevada where it's legal. Appropriately so, now that I think about it. You can do that actually in an IRA. There's good news. You can do that. You might pay a little bit of tax known as UBIT, but it is doable. For those of you interested, see me after class. What are some, let me see the topics I got that I wanted to hit, because there are a few I wanted to hit. Oh, let me tell you what I'm seeing in audits. Audits are changing rapidly and not for the better. And this isn't even, this is before the money that the Democrats put in gets to the IRS. Their attitude is already changing. First of all, you can't be fired at the IRS. That's you got to work at it. Really, you do. I've talked to some managers there, and it's frustrating to them. The pay's not very good. So think about, generically, I'm generalizing, are there exceptions? Like some genius will come up and say, John, not all IRS agents are inferior. Well, I didn't say that. I said in general. That's what that means. So if you refute me, just refute what I actually said. That's okay. Heckling is fair. Most IRS agents, there are 3 levels basically for IRS agents. You got your guys that do the audit. I'm not talking about support staff. Hey, funny shaped head, microphone moving around, head too large, getting bigger, displacing. Okay, fair. You've got your audit level agents, you've got your appeals agents, and you've got your IRS lawyers. I don't really care about the support people because I don't deal with them. The quality of auditors is dropping rapidly. Think about it. Uh-oh, am I getting a massage? Ah, see, some of you know.
I've kissed him before.
Not that there's anything wrong with that. It's just Bill's way of showing affection. And that's all he shows us, thank God. So, IRS agents, what's happening? The pay is not very good, they can't be fired. What type of people does that attract? Lazy, younger, don't want to work, don't want to be held accountable, I have power. A lot of them are woke. The IRS is extremely politically liberal, flat out woke. Flat out, you don't deserve that money, I do. So here's the trick they're playing, you got to watch for it. The best thing you can do to prepare for audits, every expense runs through a bank account, whether it's a credit card, a debit card, an electronic transfer, a check. Don't pay cash. It attracts attention if they learn about it, and you'll probably lose the deduction. I understand how it is with contractors. I'm telling you the tax law. Now, if you decide something else, like having a contractor is more important than tax law, that's a business decision you make. I'm just telling you the law. What they are doing, so you need to have a bank account so that you can prove you spent the money. You must also have, in addition, underlined, bolded, in addition, all receipts and invoices. No, your bank account statement and your credit card statement are not good enough alone, period. Period. And what I'm seeing with these young agents, they're lazy, they're vicious. They write 1 sentence, maybe 2, usually poorly. I don't know what the online version of crayon is. If they ever discover it, that's what'll show up. Give us all your receipts. Give us all of your bank statements. Tie every single transaction in detail to the tax return. Now, that's not an audit, and I object to that. I fight that, and I normally get my way. Depends on the situation. Usually I get my way. I go, let's do a sampling. You see, an audit is a sampling. Why don't you pick a month and a few categories, and we'll do that. Now, I'm starting to get more and more agents tell me no. I demand, under power of law, because I have power, everything. I write 2 sentences, and you go through hell supplying all of that, and I disallow anything you can't find. Sometimes they'll force it. Here's the situation where they'll force it. If you did something that looks bad, I'm going to have a harder time defending you. Let me give you an example. This is a real audit I had. The guy wrote off a very large boat by simply putting a banner on it saying, "We buy houses." I think everybody realized that is bovine feces. Even I cannot defend that. That so enraged the agent that he opened every return and every year that he could and started disallowing everything he could. And because he had a rationale, listen, if you're this nasty, not even aggressive, just dumb on your deductions, there's got to be way more for me to find. And so you could just hear the rubber gloves snapping. If you were in that position, you brought it on yourself. Guys, I believe in being aggressive. When the law is black and white, you have to follow the law. If you don't like it, maybe some of you, not all of you, some of you should become more politically involved.
Amen.
Yeah, Jeff will preach on that. For example, Republicans, I'm not going to say names, but you might want to go to the primaries and pick a candidate who can actually win. Yeah, I mean, or you can just complain about how you lost and it wasn't your fault and it was nefarious forces arrayed against you. That's great. Too soon? For some of you who vote the wrong way, stop being Marxists. That would be helpful. Why are you listening to me on how to reduce taxes when you vote to increase them? Well, I want them to go up for everybody else. It's how Youngstowners say hello, but in certain Sicilian subdialects has a more intimate meaning. If you have bank statements and receipts, receipts are not that hard. Nowadays, almost all receipts are emailable. Have one email address, even if you have a bunch of different businesses, because ideally you would have an email address for each business that you email receipts to. That's ideal. Why am I not asking you to do that? Because I know you. You won't do it. So I'm going to have to compromise and ask for something attainable. Have one email address where all receipts for businesses, no matter which entity it's in, et cetera, get mailed to. And don't ever look at them. Don't open those emails. Don't download the receipts. Ignore them until there's an audit. Once there's an audit, hire a Filipino VA, or if it's in 2 or 3 years, AI, to sort through those. Don't look at them. The ones that you cannot email, take a picture of, immediately send the picture to your admin, have your admin upload it and save it in electronic form. You don't need the paper. By the way, touching ink on receipts is really bad for you. Google receipt ink estrogen, not good. Take a picture of it, tell the clerk to throw it away. That's, your minimum wage. You can have cancer. Oh, I'm sorry, was that wrong? People say I'm arrogant. That's not true. It would be a flaw. It takes some people never get that. They really are inferior. Take pictures of all the receipts, email them to your assistant, have your assistant put them on some server 5 times on different servers. Because does the IRS care why you don't have records? They do not. Oh, some idiot here will say the Cohen rule, C-O-H-A-N. It's a rule that's often quoted by TikTok, like, oh my God, so we're on TikTok, and I'm gonna give you some really great tax advice. If you don't have receipts, there's a case called Cohen, and it means like you don't need the receipts. Not exactly what it said. Without going into details, you want the receipts. Upload them, save them in a trillion different places, so even if we get nuked, which, by the way, I just saw the IRS has a contingency plan to perpetuate itself in the event of, among other things, nuclear war. Talk about bureaucracies being immortal. Reagan said it, right? There's nothing more permanent than a government program. Yeah, the temporary government programs are worse. So you need to have the receipts and the bank statements. If you have it and you have QuickBooks or Xero or something equivalent. Most real estate investors use QuickBooks. A lot are moving to Xero because QuickBooks has frankly gotten greedy, stupid greedy in terms of their prices. Xero works pretty well. If you have books with balance sheets and income statements by property, in QuickBooks you would use class to differentiate, and it ties to your bank accounts perfectly, 80% of the, and you have the receipts, 80% of the audit is over. 80% of the audit is over. All they can disagree on is how did you classify given things. And a lot of the time, when your feces is in that kind of order, the audit ends. I've seen it on so many occasions where when you're clearly put together, everything is in order, the audit tends to end very quickly. The converse, you do not want to pay my rate or even a normal accountant's rate to reconstitute your books. We're doing that in 2 audits right now. I don't enjoy doing it. I charge a lot to do it, and the taxpayer's not happy. In fact, at some point, it's enough that they may just pay the tax because it's cheaper, which is unfortunate. So if it's all you do, please, 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 start keeping all the receipts in electronic form, keep all the bank statements in electronic form. Don't count on that your bank will have those for you later. They don't always. Download them, have multiple copies. If your QuickBooks ties to that, your chances of victory have just gone up greatly. Your costs have just gone down massively. Now, I don't like this. I vote against it. I vote to end the income tax as we know it, and I vote to force me to get an honest job. I just don't think it's going to happen. A couple more thoughts. Entities. You guys overdo entities, especially the newbies. The first couple things to do with asset protection. 1, don't get sued. Sounds trite, but how you treat people, how you do things matters. Knowing the law, knowing what you're responsible for in whatever business you're in, takes time, effort, and energy. It's real asset protection. Insurance. This is not a place to be cheap. High deductibles. Insurance is not meant to cover everyday events. Insurance is meant to cover disasters. High deductible, and use the savings to get more coverage. Are we slipping? Am I switching? Oh, this will be awkward. Does it detach? There we go. Pull that up through, because Bill was getting excited. The dude put a picture of me on the screen. Shirtless. Weird? I don't know. Entities. Let's back to insurance. Guys, get higher deductibles that would be painful but not ruinous. Get higher deductibles that would be painful but not ruinous, and use the savings to buy larger coverage. That'll avoid a lot of things. Open your damned wallet, maybe collectively with a few other people, and pay an actual insurance litigator to go through the policy and tell you what is and is not covered under each state's specific, peculiar, weird, mysterious law. You will be surprised at some of the things that are not covered. You then have a decision to make. Do I pay for more coverage? Depends on how much it costs. Or do I change how I run my business? For example, the classic example, bad dogs are not covered. What's a bad dog? Anything one of my trailer park tenants would have owned. Right? Because for them, the dog is not actually a pet. It is a statement as to their status as a badass male with tiny reproductive organs. The insurance doesn't cover those. You can buy riders that will cover them. You have to decide if it's worth it. I decided it wasn't worth it. We got rid of everybody who had those kinds of dogs. We just got rid of them. And it was fun. I mean, you haven't lived until you've dealt with real, right, proper trailer people. I got a real education. It was not cheap. But you know, I'd look in the yard and there'd be dog feces because they're too lazy to clean it. And I'd say, yeah, you got a dog here because I see the stuff in the yard. And they're like, no, we don't. And then you hear, woof. And they're like, well, that dog's just visiting. So are you. Entities are the last line of defense. Have them, use them, understand them. You guys obsess on them. They don't protect you nearly as well as you think they do. They're better than nothing. I'll take a bulletproof vest over a t-shirt in a gunfight any day, but if you get shot in the face, you still die. Attempts to make things perfect will backfire. Jeff knows what I'm going to say. My favorite Voltaire quote applies to you political ideologues, you utopians. The perfect is the enemy of the good. There is so much good that is attainable in the real world. Human perfection is impossible. Attempts to get it kill attempts to actually do good. Perfect is the enemy of the good. This is true with asset protection. I have a bulletproof plan. No, you don't. I am going to convert my limited liability company into a no liability company. I'm going to do equity stripping. All right, let me take a look at you and we'll discuss half of that sentence. Equity? No. Stripping? Perhaps. Making entities into no liability companies will backfire. They're called limited liability companies for a reason. Nevada and Utah people, 95%, so strong generalization here. There are some exceptions, but 95% of Utah and Nevada people who sell asset protection or tax planning are vermin. They are absolute vermin. They're very good at marketing, they're not very good at law, and they're very bad at truth. Avoid them. One property per entity, for example, lunacy. If the entities are too thinly capitalized, they don't have enough meat in them, that a judge says, this is an abuse of the system, you're done. Now, if each property is, I don't know, a $100 million trailer park, okay, you got some skin in the game. One entity per property might make sense. So, sadly, size does matter. One of the schemes that I've been seeing going around a lot in the RIA groups and with smaller to mid-sized real estate investors, so-called common law, constitutional, pure, or complex trusts. If someone offers you a trust scheme where your business and you personally pay no taxes, it is a heaping pile of bullshit. I've examined a number of them now. And usually you can tell by the marketing. There'll be a marketer who is not a lawyer or accountant. They get paid a huge commission. They don't know what they're talking about. And the marketing is comical. Well, according to King John's law, under the Magna Carta and under common law, which takes precedence over the U.S. Constitution and statutes, or under the U.S. Constitution, certain types of trusts aren't taxable. Bullshit. If you have one, stop. If you know people who have them, let them know. They won't listen because it's people confirmation bias. You tell them what they want to hear. Trusts can be used very well and very legitimately, but those types of trusts, you can tell from the marketing. As soon as they get into tax-free, one of the common things I'll see in those trusts, extraordinary dividends are not taxable, is usually a quote they make, and I can even trace the genesis of where they got that info and why it's wrong. Extraordinary dividends are not taxable. And so what makes a dividend extraordinary with these trusts? You do this. I deem thee extraordinary. It's like Lake Wobegon, but better. The kids are all above average and the dividends are all extraordinary. Congratulations. Too good to be true. When you're getting started, newbies, usually, if you're truly a newbie, now let's distinguish. If you're an MD, you've been practicing for a few years, you got some wealth, you're a newbie in real estate, but not in general. Your structure will be a little more complicated because you have something to protect, both in terms of income and assets. What's the first requirement of asset protection? Assets. I just am amazed at the people who spend thousands of dollars protecting things they don't own yet. Look, I'm a lawyer. I'm the one who makes money off of these structures, and here's what I'm telling you. In the beginning, if you're truly new, set up one entity, just a simple LLC. Don't make it an S Corp, don't make it a C Corp, and run all the businesses through it until we figure out which one or ones is actually going to fly. Because I've seen you guys spend so much money up front. You have these dreams, that's great, that's what makes you entrepreneurs. You're gonna have all these businesses, you set up all these entities. I would not set up multiple entities until I have at least one business that clearly is going to function. Now, sometimes you know really quickly. That can happen really fast. That it's, oh, time to break this business out into another one. But don't overthink this, don't overdo it. Don't fall prey to the fearmongers. And remember, all human things are subject to entropy. All things human are subject to entropy. Your bodies, our buildings, this marvelous republic that used to be a republic and no longer is. That's no joke. In a republic, here's a pop quiz. Now, those of you under 35 won't know because you weren't taught civics. In a republic, who makes the laws? The legislature. Anybody disagree? In a republic, the legislature makes the laws? What percentage of the laws in the United States are actually made by the legislature? Leon, you're an optimist. He said 20%. I would say 5 to 10% annually. Just compare the federal regulations, which are made by not Congress, to laws passed by Congress. And you'll see, volume-wise, unelected, unfireable bureaucrats make a lot more law than Congress. And that is your fault. You people, by the way, not me, because I do my part. That's why I get to be all preachy. You people don't fight. You make money and focus on making money off a system built by better people than you. And yes, some did own slaves. Anybody here object to slavery? Only a few of you? Like, well, John, this is the Commonwealth of Virginia. Of course everybody objects to slavery. And so you know what you need to do? Smash your iPhone now. Oh, that's a little different, isn't it? Just saying, you guys don't do your part. Back to our regularly scheduled programming. Rollover business startup. This is a game changer. What's a rollover business startup? Guys, any one of these topics I could spend an hour or two going over. I'm giving you a checklist of some stuff that occurred to me that I have 30 minutes left to talk about. Rollover business startup. It is a 401k, preferably a Roth. Let's just stipulate Roth, because Roth is better. Roth 401k owns a C corporation. C corporation pays a 21% federal tax. You can work for it. That's normally a prohibited transaction. Here it's not. Not with a rollover business startup. You can take a salary. You can guarantee debt. Let me give you an example. Flippers in the room or assigners. You could set up a C Corp. Now, you don't actually do it. I'm being colloquial and generic. We pay experts to do this. And not even me. I don't set those up. I know how they work. I refer you to people. You have your expert set up a C Corp. You have the 401k buy it, usually for right around 50 grand, no less. There's an optics issue with paying less. You make sure that the 401k is a Roth. If you have to convert, pay it. It's worth it. The C Corp borrows. It borrows cheaply because, unlike in most IRA or 401k owned entities, you are allowed to personally guarantee the debt. And it starts doing what you do. Now you say, well, John, all the money's in the C Corp and it's owned by the 401k, but I need money. I got needs. Like, you could talk to me in a way that I understand. You would say, John, bourbon. I'm under 59 and a half. My 401k cannot pay for bourbon, and that troubles me. Understandably so. The 401k, or I should say the C Corp, can pay you a salary. You can take a salary from this thing, but it has to be set up correctly. So think about this. This is how I run my stuff in the States. In Puerto Rico, I pay 4 to 6% income tax, but Puerto Rico has no jurisdiction right here. Were I to make money here, Ingersoll wouldn't let me. I'd run it through a Robs. I'd pay 21%, or the C Corp would pay 21%. Let's round, it pays 20%. Where does the other 80% go? To my Roth 401k. What is happening to my Roth 401k when I speak on a stage in the United States? It grows faster than Trump's ego. Yeah, I mean, come on. If you can't make fun of Trump. I can't find a Biden analogy because there's no growth there. Yes, I'm making all this up as I go. It was not planned. Rollover business startup. What's the biggest obstacle to having one? Employees. If you have employees anywhere in your structure, because here's your usual solution, I'll just set up another entity and it'll have the 401k and we'll just screw the employees out of it. There are rules for the tax people in the room, the controlled group rules that make that not impossible, but difficult. So if you have employees, I'm not saying you cannot do a ROBS, it just gets a lot more complicated. When's the time to do it? Before you have employees. It's great for flipping businesses. Why? Must you run all your flips through one entity? No. You could have a C Corp, an S Corp, a ROBS, and you can decide which property or assignment goes into which. Now, if I had a ROBS, I just run it all through there. It all goes to my Roth 401k, except for the part I pull out as a salary to not starve and die. That is a powerful tool if you don't have employees. Now, the hard part is finding a provider, because if you Google on the internet, rollover business startup, ROBS, rollover business startup, it's everywhere. It's very common in the franchise industry. There are booths at their conferences where they sell them to you. It's been going around for at least 15 years. The IRS is very aware of it. They even wrote a list of why we hate them. But they wrote reasons, and so the better providers actually deal with why the IRS hates them so that they don't hate them. There have been no court cases. I like that. That tells me they're not pushing them. It's not getting pushed. I like that. Now, what's the problem? Most providers are used to franchises, not to whatever it is you do, and most providers don't understand self-directed. There are a very few providers that can do a ROBS and will allow you to self-direct it. Those are the ones you want. I have referrals. I'll give you emails to contact me at. I track my referrals. I track my referrals to see how they pan out, to see how you pan out, because I do have a blacklist of, I'm not allowed to say that. We have a list of people that I don't do business with, that never, for no amount of money, will I take them. I'll give you an example. We had one at she went to my last two conferences, and total real estate investor sort. Like I even put at my conferences on the website at the bottom, do not call me to haggle. I'm not in foreclosure, I'm not getting a divorce, and I haven't lost my job. Do not waste my time, which I sell, trying to persuade me to take less money from you. It just irritates me. And as you can imagine, when I get irritated, it gets colorful. So the lady, it's just a classic, don't do this. I was exhausted at the end of this entities conference I gave in March. And she caught me in a weak moment. We were drinking. No, I mean, at my conferences, 4 p.m. to 5 p.m. is bourbon time. I don't see anything wrong with this. So she comes up at 5 p.m. and says, hey, can I get a discount for next month? And normally I would tell her, no, didn't you read the website? Go away. And for some reason I was weak and I'm like, yeah, sure, $100. And then she kept trying to haggle and I said, stop, you have 5 minutes to sign up for it. I should not have agreed to this, it encourages the others. You caught me in a moment of weakness, stop. So she signs up. Then she calls the office and says it's the wrong discount, she's owed more. She's wasting time. Then, the day before the conference that she got the discount for, she cancels and demands a refund. So of course I gave it to her, but I just accompanied the email with, do not ever contact me or mine again for any reason ever. And she actually tried to give the money back, and I'm like, no, you already wasted my time. Just. With referrals, I give a lot of referrals. We'll give you information to get a hold of me. I don't have referrals for everything. The CPA industry is declining in absolute numbers, not just percentage numbers. There are fewer tax professionals every day. Some of it is, like me, I don't want to hire, especially not if you're under, say, 40. I'm just tired of dealing with you and the things you've been taught that aren't so. It's a generalization, so let us not soil our britches. Like, he's talking about me. Well, I think you know if I'm talking about you or not. They don't want to hire. The IRS has become a feces show, especially during COVID. The competence levels are dropping. It's stressful. The number of tax advisors out there is dropping. Have a care before you fire yours. Think real carefully about that, because they are dropping in numbers. And there are other reasons. But be aware of that. So rollover business startup, ROBS, easily Googled, but you got to tweak it, not franchise, yes, self-directed. You know, you want to change someone's life? Catch an MD or a dentist who is still at their W-2 job, but is going to leave and start their own practice. Catch them before they hire someone. You will change their lives. Think about dentists and doctors being able to run a practice through a C Corp, pay 21% federal, take whatever salary you need, everything else dumps into a Roth 401k. That's life-changing. But you got to catch them before they hire someone. Once they hire someone, it gets complex. I am tempted to go to the medical schools, which are now teaching people how to be woke instead of, say, save my life, and preach it to these people. Like, if you ever leave to start a practice, please set up a rollover business startup before you hire that first employee. Because that's usually my issue with my doctor and dentist clients. Once they have employees, that's much, much harder to do. Partnership, what about it? If you have two partners, can you still do it? Depends, I don't know. It depends, yeah, that's very fact specific. In fact, I did want to leave time for questions. So let me burn through. Oh, checkbook LLCs. How many people know what a checkbook LLC is? Okay, checkbook LLC, for those who don't know, it's an LLC 100% owned typically by your IRA. Could be a health savings account, could be a Coverdale, and you're the manager. Well, there was a case called McNulty that an awful lot of people are ignoring. Watson and I disagree on this. He has to be wrong once in a while just because. Doesn't happen a lot, but you know, he's human. That's how we refer to someone who disagrees with me on something. Checkbook LLCs, what did the court say? If you have constructive receipt of assets, not physical receipt, you have constructive receipt, which means like imaginary receipt. The asset is deemed distributed. What's the test for constructive receipt? Complete control and dominion. I'm paraphrasing. Complete control and dominion over the asset. Let me ask you this. You have an IRA, it owns an LLC, 100%, you're the manager. Do you have complete control over what the bank account does? Yeah. Could it write you a check? I'm not asking did it or shall it. Could it? Yeah. I think that if the IRS gets smart, they can go after checkbook LLCs on the idea that anytime the manager had complete control over the bank account, they have complete control and dominion, every dollar that touched the bank account, which by the way would be all of them, can be distributed, forced distribution. So we have a problem there. What's the solution? It may be worse than the disease. You have a choice to make. My proposed solution is you have a separate manager, a banking manager, who can write checks from the account. You no longer have the power to write checks or otherwise move money from the account. Now, they only have the power to do it as directed, but there's override language in the operating agreement that says they can never ever write a check, or I'm using the term generically, wire money, whatever, such that it ever makes its way to you, directly or indirectly. If they have any reason to believe it's going to make its way to you, they simply say, no, we're not doing this. I think that's a defense. What's the problem? You got another human involved. They got control over your money. Trade-offs. Life ain't perfect. Now you have to decide what's worse. You may want to question, do I really need a checkbook LLC? That's a separate discussion. A lot of people have them because they want them, but not because they have a good reason to have them. Well, I just want to get around the custodian. I just don't like the hassle. I just want to get around the custodian. That is a bad reason, and the tax court made it explicitly clear that's a really bad reason to have a checkbook LLC. So for those of you who use that structure, think it through. A couple other things I wanted to mention in my copious notes. Cost segregation. This is accelerated depreciation. For those of you who have not done it, and it's not a good fit for all of you, without explaining terms because we don't have time. If you don't know what the terms mean, it's probably not a problem. If you know what the terms mean, it's probably worth you thinking about it. If your accountant told you cost segregation doesn't work for you because you cannot take passive losses, fair enough, fair enough. That's a good reason to not cost segregate rental property. If the accountant told you not to do cost segregation for any other reason, you want to periodically revisit that. You want to revisit the reasoning to see if it changed, especially because given that the Trump tax law is expiring slowly, God, hopefully like his electoral prospects. But anyway, the Trump tax law is expiring slowly, and so cost segregation is becoming less valuable. The sooner you do it, the more valuable it is. And what made me think of this is I have a client out west who bought a bunch of properties, a lot of properties in California in the early, what was it? The late 2000s, 2009 to 2012. And for some reason unknown to me, he put rental properties in S corporations. Don't do that. I won't go into why. Just don't put rental properties in S corps. That's very bad. And it limited the losses he could take. And so the accountant said cost segregation is no good for you because your losses are already limited based on your entity structure, which was a true statement. But he never re-examined the statement. Well, we did. We did. And it was funny because he got a little defensive and was like, no, we don't need to discuss that. I'm the tax lawyer. If you knew what we needed to discuss tax-wise, you wouldn't have hired me. So I say we discuss it. And he's glad we did. Even with S-corp issues for the tax professionals in the room, the outside basis issues, the rents have gone up so much, he now has a need for losses. And cost segregation now makes sense for this person. So if your accountant told you, don't do cost seg for any reason other than you cannot use passive losses, any reason other than that, periodically revisit that reasoning. Facts and circumstances change, so should conclusions. Update your facts and circumstances. Know what they are. No wholesaling in IRAs. Yeah, it's not real popular around here. There are malign influences telling you to do this. So, like, oh my God, I was on TikTok, and it said that if I went and got a deal locked up in my IRA for $100, and then it wholesaled the property to somebody for 20 grand, it's in my IRA and it's like tax-free. No. IRS has gone after this in a case called Mazzei, M-A-Z-Z-E-I. They went after something similar. It was not identical. But here's what they said, and they're going to win these cases. When your IRA put $100 into a deal and made 20 grand, the $100 did not do anything. It was not really very relevant. What was relevant was your personal services. The primary generator of the income was your personal services. Now, because a lot of people have gone to government schools and are not well trained to think, which is sort of the whole point of government schools, they might give a response of, so that means I can't have any personal involvement with my IRA? No, that's not what I said. If the personal involvement so outweighs the investment that the investment is fairly trivial, the IRS will simply move the income to the place that it was generated. You personally generated that income, not the $100. The income gets moved to your 1040 with very, very large penalties. Watch out for these schemes. So on TikTok it says, I can use an option instead. No. And for those of you who do wraps, again, I'm not going to explain the term. If you don't know what it means to wrap a loan, look it up. It's a very important, useful, awesome concept. And Watson, for example, would be one to talk to about it. Bill Cook would be one to talk about it. I'm sure I'm forgetting some of you because that is what I do. When you have a wrap in an IRA and a $1,000 loan from the IRA is wrapping someone else's $99,000 loan, that's just loan brokering in disguise. The IRA has to have skin in the game. For every investment made, the IRA, and I use this generically for all the retirement accounts, has to have skin in the game, which I define arbitrarily based on my experience with IRS lawyers. I would say at least 20% of the total money.
So if the total loan is 100 grand, you better have 20 grand wrapping 80 grand. I'll defend that. I don't know if I'll win, but I'll defend it. Anything below that, I'll probably decline the engagement. I probably won't defend it. I don't want to lose. I hate losing. Has reputational harm as well. If you ever do have an audit that's going bad, you have a remedy, the tax court. The tax court is cheaper than you think and a lot more powerful than you think. If you have a really bad audit, and it happens, the quality of auditors is declining. I have audits, I'm in one right now where I'm on the verge of telling the auditor, write your report, go pound sand, or salt, or salty sand, but never sandy salt, because we're going to tax court. So just write whatever thing you want to write that says the client owes $3 trillion. It's not going to stand. We're going to tax court. Without getting into details, in a bad audit, sometimes you want to stop the audit. I don't want to double bill my clients. I mean, I do, but I don't do it because it's not ethical. I will, if I know in an audit I'm not getting anywhere with an auditor and there's no chance of it, what would most lawyers do? Argue for another 80 hours and bill you to say, I fought for you. No. I tell the client, there's nothing on this earth that's going to change this person's opinion. We should just tell them to go ahead and write their report. We're going to tax court, so then I can bill you, but get a different result. So that's something to look forward to. Let's see, anything else I wanted to mention here? Real estate professional status. If you use property managers, watch out. If you use property managers, real estate professional status, and again, if you don't know what it means, don't worry about it. It doesn't affect you yet. But for those of you who do know what it means, a little more advanced, and you rely on the losses from your rentals to offset other income, if you use property managers, you have to show that you are actively involved in hands-on management, not just checking statements. I manage the managers. Oh, isn't that cute? You're going to have a hard time qualifying as a real estate professional. I'm not saying impossible, and sometimes we can tweak it or put our thumb on the scale to get you actively involved in managing the rentals in particular. Managing the rentals. You have to be active enough that your hours count. I'm seeing some of those cases come down the pike where people manage the managers and they're losing. Be aware of that. All right, we have about 9 minutes. Questions, and guys, I will not answer every question. I will judge how much good it does the room. So your super specific applies only to you question might not get answered. Oh, let's start with Bill, and then we'll go over here.
Remind me about your Wednesday night calls, your Zoom calls.
Wednesday night calls, just very briefly, if you want, I'll put up how to get a hold of me here. Let's see, we got to get the computer on. We have to turn it on. Oh, you're so beautiful. It makes, I'm going to grab you by the mouse. No. Didn't work. Somebody who knows technical things, make that function, please. Very briefly, I do twice a month, the second Wednesday of the month and the fourth Wednesday of the month. I do webinars. The easiest way to get a hold of me by far. I mean, you can become a client at $1,000 an hour, and I'll eventually call you. I'm good at planning issues, stuff that you need right now, not so much. I do these webinars. The first one is just bailing because, got the good information, announced the marketing.
I was waiting till you looked that way.
Yeah. You do know that the Eye of Sauron moves. But anyway, very briefly, because Bill asked, first Wednesday of the month, we pick a topic. It could be ROBs. It could be discounting conversions from traditional to Roth. It could be entity structuring. We always pick a topic and we record them. We have about almost 5 years of archives. The second Wednesday of the month, 7 p.m., 2 hours, is pure Q&A. It's pure Q&A. Usually I save you enough money with one idea that it pays for these forever because I only charge $100 a month. It's a thought. If you want to do it, great. If not, great. Great question. Thank you, Bill. Your check is not in the mail. The question is for doctors and dentists, let's say they set up the ROBs before they have employees. Once they set up the practice and have employees, who would employ the employees? Probably the C corporation that's part of the ROBs. I don't see a need to not have the employees there. Now, what you want to avoid is ever contributing more capital to it. Because if you contribute capital again later, now you got to include them. So you contribute capital once pre-employee. And then like the IRS says, well, employees have to be offered the opportunity to contribute. Didn't have any at the time. Okay. And by the way, they're very aware of this issue.
It's coming.
Okay.
It might have overheated.
I'm sorry?
It may have overheated or something.
No, I have literally, I will be dropped on China in the event of war. Ask my kids, I have this effect on technology. I touch it, it dies. 1, 2. Okay, the question is, if I'm a real estate professional, I have 2 portfolios, some managed by managers, others managed by me, and record keeping. Very briefly, that's a good situation. I can work with it. Why? Real estate professional status, without going into the details that we lack time for, because trust me, I would love to talk about it. Real estate professional status is a function of one thing. Do you spend enough time in the required activities? Because I get this all the time. Like the agent I was talking about, he's dumb enough. He's like, show me that your client has a real estate license. Irrelevant. Has nothing to do with the tax code definition of being a real estate professional. It is how much time do you spend in real estate overall, as defined by the code, not by you, and how much time do you spend hands-on managing rentals? Now, in your case, first of all, the tax court says to qualify as a real estate professional, you don't have to track your hours. Let me tell you what that means. You have to track your hours. No, because the vast majority of people who don't track their hours lose. You have to have a really compelling testimony to win the real estate professional argument without hours. In your case, it's not that hard to do if you can get the normal number of hours that you have to spend on the rentals, and this varies. I'm being very generic. Typically, it's 500 hours, 10 hours a week. If you can show you spend 10 hours a week hands-on on the properties not managed by managers, you're probably home free, period. You're probably home free, period. There are other complexities.
What if a chunk of that is managing managers?
Oh no, see if, again, so what if a chunk of that is managing the managers? It's too much detail. Let's put it this way. I have to show, I have a client I'm actually litigating in tax court. He manages the managers. He's going to win. You know why? A, he has good records, and B, he's in California, the properties are in Texas. He flies there twice a month, records the number of hours that he is on the ground, making tenant decisions, making groundskeeping decisions, making rehab decisions. That's hands-on enough that even though there are managers involved, he is considered to be one of them. If on the other hand, it's really pretty passive and my managing the managers is just reviewing financials, you are dead. No chance of winning that argument at all, 0. So the very thing you seek, that it is passive, is the very thing that will torpedo real estate professional status. And now you have choices to make in terms of lifestyle versus taxes. I would point out that for the test I'm talking about, because there are 3 tests for real estate professional status, the time you spend on rentals, if you're married filing joint, both spouses' time counts. Both spouses' time counts towards that 500 hours. This is a complicated thing, and unfortunately the IRS is pretty good at it. They litigate it a lot, especially in California. So they've gotten good at it. You can't rely on their incompetence, which is vast, to save you here.
Does that mean 20 hours to clarify?
I can't go into more details. It would mean explaining it all to you. I had someone here. Yep. Okay. This is a great question. Okay, we got somebody who's done some reading. How does material participation on short-term rentals works? I have 2 minutes and 9 seconds. I did an entire webinar on short-term rentals as part of my regular series. For the CPAs in the room, I will eventually make it qualify for CPE because so many of you requested that. Short-term rentals have the option to be treated as either rentals or as hotels. And it's a different definition in different parts of the code. So it might be a rental for self-employment tax purposes, which is really good. It means you're not paying self-employment taxes. If your accountant is putting your short-term rentals on Schedule C, as in Charlie, and hitting you with self-employment tax, if you don't have a maid in there daily, changing the sheets and all that, it's probably wrong. Let me repeat it, it's really important. Because CPAs, some of them think you have to put short-term rentals on Schedule C and pay self-employment tax. You only have to do that if there is, let's see, the term was substantial services above and beyond what would be provided to the building and to a normal tenant. So if you got a maid in there changing the sheets every day, it's probably more of a hotel for self-employment tax purposes than a rental. But for passive loss purposes, it's a totally different definition. Totally different definition. So you can sweet spot this. You can put it on Schedule E as a rental and not pay Social Security tax, but still take the losses even if you're not a real estate professional, because for passive loss purposes, you were able to define it as a hotel. So the definition, the code is not consistent. The words, you remember the Princess Bride? You keep using that word. I do not think that word means what you think it means. Well, in the code, the word does not mean the same thing in different parts of the code. There are some words that have 15 different definitions depending on which part of the Internal Revenue Code you are in. So the takeaway from a very astute question, short-term rentals, if you play the game right, can be defined as rental for self-employment taxes, which is good. You don't pay self-employment tax, it goes on Schedule E, but as not a rental for passive loss purposes, meaning that people who do not qualify as real estate professionals might still finagle to get the loss on their 1040. Hope you guys got something good out of this. There was something up there that said how to get a hold of me. For the camera, it is taxreductionlawyer.com, taxreductionlawyer.com. I put out a lot of content. I'll be putting out more. It's a moral obligation to pay the least possible to those bastards, legally and ethically, of course. So cheers.